everyone. Welcome to the tax session. I believe March 30 is a good time to do tax session. For all those of you who are ahead of the curve and have already done your tax filings, amazing. There's something I can learn from you. For those of you who, like me, are thinking that we are approaching the deadline and let's do it, maybe this tax session will be handy. And the intent of having this session was to talk about taxes both in the context of your investments with Buy Properly, but the overall context. As Buy Properly, of course, our vision is to democratize wealth building, and tax is a very integral part of wealth building. And so while not everybody has the luxuries of the PwCs of the world to back them up, only large corporates do, we all need to be very well aware of all of the things in the tax system to ensure not just that we file taxes, but also we are making the best use of the financial support available from government side. So we have today with us Mr. Anil Sharma. Anil Sharma is a CPA. He's a tax and accounting expert. He has over 20 years of experience. And honestly, as a firm, we work with him very closely. We work with a lot of large accounting firms, and Anil alone actually probably can put all of the others put together to shame through his knowledge. So I'm very, very thankful for him to come to our forum and share his wisdom with us. Anil, we would like to cover a little bit about the overview of the tax system, what individuals and corporates should be considering when they are talking about the tax system. And somewhere within your session, I'm not a tax expert, but I would like to explain from tax perspective, the legal structures we use for our deals at Buy Properly and why we have chosen those structures for our customers' benefit. So over to you now, Anil, and I'll let you give all of us some guidance on this.
Thank you, Khushbu. Hi, everyone. And Khushbu, thank you so much for such a great introduction. And really appreciate that and really appreciate the opportunity to share some of the tax updates with you and the group who have been investing with you. So this is mainly tax related to 22 and 2023 that I will be covering. And main topics that we will be talking about are basically Canadian tax system, tax rates, and some credits which are available, what kind of taxation is applicable to different kind of income, real estate taxation, whether people should invest through personal or corporation, some tax saving tips, scams and frauds, and of course, any questions that comes to mind, I'll be happy to answer those. And Khushbu, would you like to take the questions at the end, or would you? How do you want to do those things?
I think at logical points during the presentation, Anil, it's sometimes better to do it at a few points in the whole conversation rather than losing the context. So I'll keep reading those questions as we go along. And if they are relevant to what you're presenting at that moment, then I will highlight it and we can take it up as that. Otherwise, we'll take those in the end, whatever remains.
Okay, that's perfect. That's perfect. Yeah, let me know if I need to take any questions at that time. Okay, so let's get started. So the Canadian tax system is based on the residency status of the person. It's not based on the citizenship of the person. Some countries like US, they tax you based on citizenship. But in Canada, if you are living in Canada, you may not be a citizen. You could be just a permanent resident, or you could be a visitor living here beyond certain time frame. You could be taxable in Canada. And in some circumstances, you could be taxed even if you are not physically in Canada. Example for that could be when you have a family. So wife and kids live here, but husband goes out to work. The person still have substantial residential ties to Canada, and that person is subject to Canadian taxes. Canadian residents and non-residents, they are taxed differently. Canadian residents are taxed on their worldwide income in Canada. However, non-residents are taxed only on their Canadian sourced income. Canadian tax system is on a graduated rate system. It means higher the income, more the taxes. And as I said earlier, various types of income are taxed differently, and we will cover those in subsequent slide. Here are some of the tax rates and credits which are mostly applicable to individuals. So if you, you could up to 53,359, the marginal tax rate is 15%, and from 53 to 106,000 is 20.5%. But on an income of 53,359, tax payable is 8,004. The highest tax bracket federally is 33%, and that starts at 235,675. Some of the common tax credit which are available to individuals are basic personal amount, which is $15,000. But if the income is more than 150,000, that goes down a little bit. Same thing is for a common law partner or for spouse or an eligible dependent under 18. Same maximum amount of 15,000 is available. Person over 65 years of age, they get an age amount of 8,396. And there is a disability amount for people with disability at 9,428. There is something called Canada Caregiver Amount for children under age of 18, and that's 2,499. And a dependent who is over 18 but disabled, you can have a Canada Caregiver amount of 7,999. Mind you, these amounts, 15,000 basic personal account doesn't mean that you get a $15,000 tax break. It translates into a tax benefit of about 15% of these amounts. So for basic personal amount of $15,000, the maximum tax credit that you can get is $2,250, which is 15%. These are some, amounts for 4 major provinces where people will pay taxes on different levels of income. So on a $50,000 income, Alberta, in Alberta, we'll pay $8,150, and Quebec, you pay $9,492. Idea of this slide is for you to know how much taxes are payable in each province and which one is the most tax efficient or most tax expensive province in Canada. Anything for $200,000 income, Alberta, you pay $61,439. Ontario, $67,758. BC is $62,755, and Quebec is the highest, which is $76,566. Now, you could have different kind of income, and not every income is taxed in a similar way. Regular income like employment, business income, withdrawal from RRSP, RIF, or interest, they are taxed at your marginal tax rate. Marginal tax rate is basically your highest tax rate applicable to your income. In Ontario, highest marginal tax rate is 53.53%, which is about $235,000 of income. So if you have any income at those rates, so that will be taxable at 53.53%. Capital gains are the most tax efficient kind of income because only half of taxable capital gain is taxed. Although rate is still your highest marginal rate, but because only half of it is taxable, so the effective tax rate comes to 26.76%. Second most efficient income stream is eligible dividend. Eligible dividend comes from mostly listed companies And even from the small companies which have higher income, higher taxable income, they can also provide eligible Canadian dividends. And the tax rate on those at the highest tax bracket is 39.34%. Dividend which comes from small business corporation, let's say if someone has a corporation and they want to withdraw dividend from there, which is dividend other than the eligible dividend, tax rate on that is quite high as well. It comes to 47.74%. So in this example, you could see if you have a $10,000 income, so on the regular income after tax, you get only $4,647. And the best you get under capital gains, where you get 7,324.
So Anil, at this stage, I would love for you to also cover some of the tax that gets applicable through our structure. So I think most of our, at least existing customers, would know that the structure that we use is a general partnership, limited partnership. We obviously ran a lot of cost benefit analyses between corporates, creating a corporate structure, a company, all kinds of corporates and partnerships. And this was in terms of total cost over time, this was the most efficient setup. So we use that. We obviously, and people's tax slips, the customers' tax slips are going live right now. They're getting uploaded into their systems. So maybe if we could cover the taxes that get applicable for the buy property customers in the investments. And there are two kinds of investments. There are the development projects, which are not doing any distributions because most of it is at the end of the development project. And there are the rental income projects where there is rental income and distribution at times that's being done during the year. So maybe if you could cover the relevant tax buckets that those fall into.
Yeah, for sure. That's a very good idea, Khushbu. So your structure is very efficient in terms of there are no intermediary tax costs, because if you go through a corporation, then any income earned in the corporation first will have to be taxed in the corporation, and only remainder can be distributed to the shareholder or investor. So there is a cost of investing in the corporation, but in your structure, that cost is not applicable. Any income which is earned in your structure is passed on to the investors directly, and they deal with their own taxes depending on their own marginal tax rate. So that's a very good positive point, that there is no intermediary tax cost in this structure. Now, the income from buy properly investment could fall in various buckets. Like you said, rental income. If there's a rental income profit in the partnership and is distributed to the investor, it goes as a rental income to that. And that is declared on their tax return as rental income, and then they pay tax according to their own marginal tax rate. There could be, if the property is sold at a later date, there could be a capital gain on that property. And as a partnership, when capital gain happens, you will be passing on those capital gain to the investors directly, and they will benefit from that capital gain tax efficiency there. At times, there could be, when you are distributing, even though there is there may not be a profit in the partnership, but you are still giving distribution to the investor, that goes to them as a return of capital. So they get the cash in hand, but they don't pay any tax on it because that's a return of capital for them.
Got it. Thank you, Anil. Could you expand a little bit more on the return of capital? Because most people understand that rental income is equal to distribution, and that's straightforward. And capital gains is when we sell. Those are the easy pieces. The return of capital, and we as a company definitely want to leverage all of the possibilities of how we do it, including the return of capital where we are doing distributions, even though at the end of the year, the partnership hasn't made profit, but on a quarter-to-quarter basis, there's spare cash to be distributed, and how that impacts their total tax liability. And then the second piece I do want you to talk about is how we are leveraging depreciation in some of this for tax advantages.
Right. So, and that's where, so return of capital is, let's say someone has invested $10,000. During the year, the partnership did not have much of a profit, but have positive cash flow, and that money can go back to the investor. Instead of a profit, it can go as a return of capital. That reduces their cost base of the unit. So from $10,000, if you return $1,000 to the investor as return of capital, now their cost base for the investment is 9,000. At a later date, when the property is sold or the units are sold, that could turn into a capital gain, right? It will increase the capital gain at the later date, and capital gain being the tax efficient side of it, they will benefit from that. As regard the depreciation, so you have the profit in the partnership, but you have an asset there building. You can claim depreciation on it to reduce the taxable income of the partnership and allocate that depreciation to the shareholders, to the partners. So that depreciation flow through can offset their tax liability against the distribution.
Thank you, Anil. And I would like to reiterate, and Anil, correct me if I'm veering off script, but in terms of how we are doing taxation at Buy Properly, yeah, we are using all of this knowledge to make sure it is tax efficient. Mind you, even though you are investing through a partnership structure, all of the tax advantages that you would have accrued if you had directly invested in a property, you will still accrue. So if there's interest deductions, if there is depreciation benefits, you're not losing any of those benefits by using our structure. And that's
That is
probably
correct.
the GPLP.
Yeah, that is correct. And that is the beauty of this structure, that all the benefits are passed through to the end user, to the investor.
Cool. Thank you, Anil. And that would probably explain sometimes you will see cash flow distributions in select quarters. And even though at the end of the year, profit and loss wise, the entity may not show a profit, there's still distribution because we had a positive cash flow quarter. So that's not a bad thing. I know we've got questions from customers in the past on this. That's not a bad thing. That's us trying to be most tax efficient. So we return cash when we can. So your overall tax liability is optimal.
Exactly. That's the goal.
Yeah.
Exactly.
Go
All
on.
right. Okay. So now, the real estate, I think we covered most of it. So real estate is a passive income. And as I said in the earlier slide, it is a regular income taxed at your marginal tax rate. Any profit on sale of real estate is taxed as a capital gain. Only half of that is taxed. Here, we should be mindful that there are some people who just buy and sell properties on a regular basis. That is not capital gain. Any gain on that is a business income because they are considered as being in the business of buying and selling the properties. So we have to be mindful of that. Anybody who is trying to invest, if they are investing for long term, then yes, on sale you realize the capital gain. But if it is happening frequently, then it will be a business income, and 100% of that will be taxable. Any pre-construction assignment sale, I got questions from so many other people about this, that when they have booked condos, when everybody was selling condos, they booked it. Now they don't want to close it, but they want to sell on assignment. That is a business income now. With the new rule that came into effect last year in May, that is all business income, and potentially there is HST applicable on it. We just had few clients who did that, and they had to pay HST on that one. So be mindful of that. Capital gains exemption is available if you are selling your principal residence. Some people call it primary residence. So if you are selling that, there is no capital gains payable. However, you still need to report that on your tax return whatever year you sell, it has to be reported and declared that you sold your principal residence. Non-reporting is subject to penalties and possibly can lead to loss of primary residence exemption. With the new rules that comes into effect, if somebody buys residential properties and sell within 12 months of that, all the gains are fully taxable as business income, no exemption.
Got it. A lot of this would not apply to us because one of the things I do want to clarify is that investing in the buy properly units is not treated as buying real estate. It's investing in a partnership. So a lot of these won't apply, especially given that we hold as a partnership for a longer term. But if you are doing real estate transactions outside of the platform, these are some of the things to be mindful of.
Exactly. Yeah, that was the intent of this slide. Yeah. Okay. Now, investing personal versus corporation. A lot of people ask about it. Even in buy properly, people are investing. So some people might ask, should we invest personally or through the corporation? There are some good points doing through the corporation or doing personally as well. Most of the time, what happens if people have money personally, they invest personally. In some cases, especially in case of professionals, they have money in their corporation stock. If they want to take it out to invest personally, they first will have to pay high tax themselves and then only invest it. In those scenarios, it is beneficial to do it through the corporation.
So Anil, this is something that I don't understand. So I'm asking. I don't know. Maybe the audience is better educated on tax than I am. But if I were a regular salaried professional, like I used to be working at a tech company and I'm getting regular salary, then does it make sense? And say I'm a very active investor. I invest in stocks. I invest in private credit. I invest in this. I make a lot of very active investment as a passive investor, but I'm actively managing my investment portfolio. Does it make sense in that case for me to use a corporate structure to make those investments? Or it only makes sense if I am a business?
Okay, so active trading of the investment, stocks, mutual funds, all those units. If you are an active trader, there is a certain benefit doing it through the corporation because then you are considered an active business and corporation have a favorable tax rate for the small business of the profit up to $500,000. However, investing is not trading. Investing is that you invest and leave it there. And that's where the corporation is not the most tax efficient structure because any investment income, which is also called passive income, is taxed heavily in the corporation.
Got it. So if I were buying 5 properties, then actually using corporation, putting money into it and investing through that is not the most tax efficient. If I were a regular, say, tech employee earning regular salaries.
Yes, if you are a regular person and if you don't have 5 full-time employees in your corporation, it doesn't make sense to invest through the corporation. There could be other reasons for investing through the corporation other than taxes, and that could be the liability issue. People who have multiple rental properties, they mostly, in spite of not being tax efficient, they want to go through the corporation for the liability reason. Because if anything goes wrong with one property, then damages are limited to that corporation rather than spilling over to their own personal assets or other investments. So there may be reasons other than the taxation to incorporate and invest through corporation.
Got it. Now you just made it all muddy in my mind. So is it good or not good to invest through corporation?
No, if we focus on the tax efficiency, then you are right. Investment through the corporation is not most tax efficient. If people have money personally, they should invest personally.
But it saves you from liability. How do you do the trade-off? Like, how do I know that beyond this, I should be worried about liability? Like, is there a way of quantifying or making it more objective, that decision, or not?
I think it's very personal. Some people feel comfortable at certain level, others can go higher.
Okay.
Yeah.
Fair enough.
Right. One other point I want to make, some people, and this question get asked sometimes, that they want to buy a property for their own residence, but they have money in their corporation. Can they buy it? If a corporation own your principal residence, then you lose the principal residence exemption. So never buy a primary home in the corporation. All right. Okay, so now we are tax planning ideas. People who are investors, if they have, in their portfolio, if they have earned capital gains or other income during the year, and if they have any losers in their portfolio, they can sell those and realize losses to offset the gains they have earned during the year. A lot of people do that, and normally around November, December of each year, they will review their portfolio and see how much gains they have, and look at the, stocks or mutual funds or whatever they are holding there. If they have, with losses, unrealized losses, people do sell those and try and offset the gains. Then other thing people do, they do RRSP contribution depending on their salary level and cash flow. It's a very good tool to put money away for a later date during the retirement. So they do contribute into RRSP. If somebody have a disability in the family, they can also contribute into a registered disability saving plan. And depending on the income level, they could actually be entitled to grant from the government of up to $70,000 there. But that all depends on the income level of the family and disability of the person. For the home buyers, there is a new plan that will start this year. I think in April or so, they will bring that into existence, and that is first-time home buyer investment plan there. People can invest up to $8,000 per year, up to a maximum of $40,000, and use that money for the first time home buying for their own residence. It can be there for 15 years, and you can, after 15 years, even if you don't buy the house, you can transfer that into your regular RRSP, no tax paid and no tax consequences. Then we have tax-free saving account. Everybody is aware of that. Every year you get a limit for that. This year the limit is $6,500. I always encourage people to invest in that. It's a very good tool. Whatever you invest and earn in that, you never pay tax on that. People do use donations to manage their tax savings as well. Some people believe that they have to do good for the society. They participate in various donation drives, and they do good. At the same time, they have some tax saving as well. For senior people, pension splitting is a very good tool. When one spouse is lower income and the other spouse is getting higher pension income from their work or from their REF or RRSP withdrawals, they can be split up to 50%. Obviously, it should be optimized based on the income level of both partners, but that's a real good tool. People should not miss it and look at that. Investment, people invest money in various investments like buy properly, stocks, mutual funds, other direct investments. So at times there could be cost of those investment, and those costs could be the interest on money invested. Maybe some people borrow money to invest, and there could be advice fee or management fee for those investment. Those are called carrying charges, and they should be deducted while preparing the tax return each year. And so I see people missing that. We always remind people to be careful about that and collect all those charges and claim that on the tax returns. There are families where there's income differential between spouses. One spouse making a lot of income, other spouse has very low income. If they want to invest, uh, you know, the higher income spouse can loan money to the lower income spouse. Obviously, there should be an agreement, proper agreement written down, and the rate of interest has to be at the prescribed rate given by CRA. Currently is 4%. It used to be 1% last year, but now it's 4%, and in April it will go to 5%. So you could loan money to the spouse at that rate, and then money in can be invested in the lower income spouse name. Any income which comes back will be taxed in the hands of lower income spouse. So there's no income attribution rule to the higher income spouse. So that could be a tax saving for many people. We have implemented that strategy for many of our clients, and they have significant savings on those.
On this last one, can you elaborate a little more? We do get questions on this one where people ask, can I invest in the... So one is the spousal, but the other is also children who have just gotten out or are of a job age. So maybe they're like 21, but in their first jobs. And so not necessarily earning at the same levels as their parents. So if you can elaborate a little more on what structures to use for us investing through a spouse, and how it would translate into practical stuff. Like if they were to invest with us, how would it really tactically work?
Yeah, so if they were to invest with buy properly, and let's say one spouse earns 500,000 a year, the other spouse doesn't make much, only $50,000. So there's obviously a tax rate differential between the two. And if the higher income spouse were to invest with buy properly, any income going back to that spouse will be taxed at highest rate, which is 53.53%. However, if that is invested through the lower income spouse, and maybe that spouse is in 20% bracket or 30% tax bracket, so there's a direct saving of that differential between 53 and 30%, 23% saving right there. However, to do that, there has to be a proper loan agreement signed between the spouse, and money should move from the higher income spouse to the lower income spouse. Agreement to be signed and witnessed, and this agreement could be a 99-year agreement. You can loan the money today, and there is no fixed term of repayment, or it could be repayable at 99 years, and it has to be at the rate of interest which is prescribed by CRA every quarter. But whatever rate is currently applicable, that will be the rate applicable throughout the term of the loan. So if it is 4% today, it will be applicable to next 10, 15, 20, 30, 50 years, whatever is the duration of the loan that has been given to the spouse. Even if the rate of interest goes to 7%, 8%, this 4% will not change for that agreement. And when that agreement is done, every year the borrowing spouse has to pay that interest to the lending spouse within 30 days of the year end. That is a must. That has to be paid. If that is not paid, then agreement becomes void, and all the income earned can be attributed back to the lending spouse.
So I'm trying to do the math, and maybe people understand, I don't necessarily. So imagine I have zero income.
Yeah.
Self-employed, I have zero income. I make no money from my startup, and I borrow 100 grand from my spouse and say, hey, this is for investing. One, I am not relieved of the interest obligation, so I have to pay that 4% every year. So if say I'm using that 100K for 5 years, I have to pay 4%. But with the 100K that I took as loan, when I invest, given that I have zero income or income sources, do I then become eligible for investments, or are there going to be, and maybe it's not a tax question, it's an investment question, but if I have no sources of income and the only source of income is this spousal loan, do I then have to add my spouse as the provider of income before I make an investment? Or because I have taken that loan, I'm eligible to actually invest as I please?
Yes, you are eligible to invest as you please, unless the platform or the investment wherever you are making that investment, if they have certain criteria to accept the investment from you.
Got it. Okay.
Right?
But under normal investing circumstances,
Yeah.
once I have that agreement that, hey, I'll pay my spouse 4% interest rate and I borrow 100 grand from my spouse, I am
Yeah.
happy to invest that money as I wish. And
Yes.
whatever income I generate from that loan or is entirely attributable to me. I
Yes.
only owe my spouse the repayment of the principal and the interest.
Right. And the interest you pay is deductible against that investment income.
Oh, okay.
Yeah.
Hmm. We do get a lot of question on this one where people would want to invest in their spouse's name because they are a different income bracket. Um, but with, I don't think, a clear methodology, they
Right.
just say, hey, it will be invested under this person, and that's about it.
Right. So if it is done without the agreement and at the
Yeah,
prescribed rate, then there is obviously it will be attributed back to the person who gave the money.
got it. Hmm.
Okay. Yeah. So
Oh, one
now,
more question, Anil, back
yeah,
on
go
that
ahead.
one.
Go ahead.
So
Yeah.
we talked about the spouse and loan. What
Yeah.
happens if you want to enable your kids to invest? Is there something like this you could do? So this is another question we often get. So I have a 21, 22 years old who obviously earns much less than I do. I want to get them started on the investment ladder. Um, is there some
Yeah.
mechanism for them?
Yeah,
That's
yeah.
what.
For the adult kids, there is no attribution
Okay.
rule. Actually, you can give them money, no problem, and they can invest, and it will be their income. For adult kids, there is no issue. It's only for the minor kids. If you give them money, then all that income is taxed in your hands. Doesn't matter
Got it.
if you have agreement or no agreement. That's taxed in your hands.
But if it's an adult kid, then you just give the
Yeah,
money to the
yeah,
kid
you can just give them the money. I mean,
as a
and
gift, and
yeah,
they.
yeah,
Okay,
yeah, yeah.
all right.
Right. The bigger question is, do you trust to give that money to them just like that?
But we are a platform with low minimums, so
Yeah.
sometimes it's not a whole lot of money. It's just
Right, 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 right.
it's
Okay.
it's enough to get somebody started in the investing world, in the real estate investing world,
Yeah,
um, without hopefully breaking trust
yeah,
or
yeah,
risking
right,
trust. Because
yeah,
this isn't $1 million. It's most
right,
people invest 10, 20 grand per deal. So,
right, 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 right. Yeah, no, that's good. I mean, there's no restriction on that, and there is no issue
okay.
with that. Yeah.
All right. Thank you.
Okay, no problem. Any other questions, Kushbu?
No, I don't know if the audience has any questions, but I guess everybody's just listening and maybe taking notes.
Yeah, okay. Okay, no, that's good. Okay, so the last slide I have is about scams and frauds. I hear a lot of people, calling, okay, oh, somebody called me and I owe them $5,000 and they want me to pay now. I mean, I had a couple sitting outside my office when I came last week in the morning, and they said they were sitting there for 2 hours and they were crying because somebody called them and they said there is something wrong with their tax return and they owe $5,000. And they wanted them to go to Home Depot, buy a gift card, and give it to them. So, what I suggest and recommend to all my clients and everybody I know, delay your reaction to those calls. Don't react right away. Try to get the agent ID or a phone number that you can call back and verify whether they are calling from the right department or not. And some of my clients actually, what they said, listen, I'm not comfortable talking to you over the phone. If I have made any mistakes or if I owe anything, send me a letter and I will respond to you. So ask for written communication. Don't have to decide on the phone, don't have to react on the phone, and just listen to them and say, okay, send it to me and we will deal with it. Or I have professional helping me, they will help me to deal with it. And CRA or any other government agency, they will never ask for payment through a gift card, right? So never buy a gift card. Doesn't matter what they say and who they are and when they call. Never do that. Also, I have seen people getting emails about, oh, you have so and so refund. Click the link, or even WhatsApp messages or text messages. So government will never send those to you. If you click on those messages, most likely your computer, your phone will be compromised and you will lose the sensitive information on there. So be aware of those and never react to those.
Thank you. There's a question, Anil,
Yeah.
regarding spousal loan. Like I said,
Yes.
that's a common question.
Yeah.
So Muhammad has a question. For
Yeah.
spousal loan agreement, is
Yeah.
there something prescribed as a template on CRA or any other source on the necessary elements to be included in the agreement?
I think if Mohammed, if you Google it, you should be able to find some agreement, or any paralegal or a lawyer in your network could help you with that. It's a very small, regular, and ordinary agreement. It doesn't have to be very fancy. Uh, you could easily find that, I think. But CRA doesn't have a prescribed template. They don't. They don't provide those things.
Okay. Thank you.
No problem.
This one was very important. I feel like we've got questions, and obviously we are not equipped to take this one on. So thank you for covering that.
No problem. No problem.
Cool.
All right. I guess that's
it. So questions, anyone on any of this? The tax slips are on their way. Some of them have gotten uploaded. Some of them have not. But they're all on the way. So everybody should have their tax slips soon.
Yeah, for sure.
Cool. So if there are no more questions, we'll end the session. Thanks a ton, Anil, for this very informative session. I personally learned a lot, and I do hope that the audience learned. What is Muhammad? One more, please. I don't know what that means. Muhammad, do you have another question? Is joint account a bad thing to have?
In what sense, Mohammed?
Can you speak up, Muhammad, maybe?
Mohammed, you are muted. Unmute yourself and then maybe speak.
Yeah, sorry, I didn't realize I'm on mute.
No worries. Yeah.
The question is, like, sometimes, if the both spousal transactions and your transactions are going into one account, it becomes difficult to justify, right? So if someone is planning this route, is it better to have different accounts, or it is okay to have joint account as long as
yeah, you see, for that investment, because that investment will be made in the name of that spouse, so that will be going through that spouse's account. That will be a separate account. I mean, you could have joint account for all, your home expenses, or your joint, mortgage going out, or other expenses. You could have a joint account. But that, for example, let's say you invest that money into buy property, right? So that investment will be in the spouse's name, and any income or slip or tax slip coming will be in the name of that spouse. So there is no ambiguity, or there's no confusion, because that will be declared on that spouse's tax return that way.
Okay, thank you.
There's another question saying, just to confirm, the rental distribution from buy property is regarded as return on capital as opposed to dividend income.
It is not dividend income for sure. Return of capital, it depends. If we are distributing profit, it will be a rental income profit, not a dividend. But if we are distributing and there was no taxable profit, then it will be a return of capital.
Given that we are very early in most of our investment cycles, Anil, I think most of the money that's being distributed will end up being a return on capital, just because when you factor in depreciation and the interest expense and all of that, the net profit is still negative for most partnerships early on in the cycle, because there are huge depreciation benefits.
That's correct.
does not mean there can be one-off case where it is not dividend income, but given where we are in our whole investment cycle, majority will likely be return on capital for tax.
Yes, that's correct.
But I'm not saying 100% because, again, that will vary from case to case, but
That's
majority will likely be return on capital.
Yeah, that is correct.
Yeah.
Okay.
Cool. Some good questions.
Yes.
All right. So I guess that's it. Thank you so much, Anil. And this was hopefully useful to all of the people attending the session as well. Thank you for your time. And if anybody wants to connect with Anil outside of the session, we'll be happy to make that connection as well.
Okay, well, thank you so much, Khushbu. Thanks for having me. And I really enjoyed presenting here. Very good questions. Appreciate all the participation from everybody. Thank you so much and have a good day.
Thank you.
Okay, bye-bye.